All right. Welcome to Thanksgiving week. Happy to have all of you with us, Principles of Accounting 2 people. It's been a great ride so far, and we are almost there. We are almost done with the semester. Already November the 25th. We're basically there. Yeah. I understand that a few of you might be graduating this semester, which is fantastic. If that is indeed the case for you, that means that we just have to have everything wrapped up by the time that I need to submit your graduation scores. So let's take a look at the classroom real quick. I'll show you where we are, what's going on, and I'm going to show you a couple of things of what we have to accomplish to wrap out the semester. So, here in the classroom, if you come down all the way down, all the way down, because we made it all the way through basically. Here we are, we're sitting in capital budgeting, investment decision analysis. Super easy discussion tonight about that. It's going to be fun. I think you're really going to enjoy it. There is just for this week, we have the quiz related to this discussion. And F. So for this Sunday night, we have the quiz related to our discussion on chapter 26, which is the last chapter in our text. Next week, we will meet very briefly on December the 4th, which is next Thursday, December the 4th. We will meet very briefly to discuss the final week, which is next week. Next week, you have just one thing to take care of for me, which is a short essay. And this is on the use of artificial intelligence in managerial accounting. Go ahead and open it up, and we are going to, just click begin, open it up, and you'll notice a couple of key elements that we are going to be doing here. So this is very experimental, something I haven't really done before. This is new for this semester. It's a short essay on using AI in accounting. And it's very simple, very easy to do. You'll use one of your favorite AI tools. It could be either ChatGPT, it could be Microsoft Copilot, Gemini, Claude, or any other AI writing assistant that you see fit. And we're going to do a couple of things with this essay, 300 to 500 words, so relatively short. You're going to select one of these topics from the list. You'll use your selected AI tool and ask questions about the topic that you've selected. So you might ask AI to help explain the topic in simple terms, use it in an example for business involving the topic, or some type of sample calculation, etc. And then once AI provides you with those results, you're going to summarize those results, 300 to 500 words. You'll look at, identify two questions that you asked the AI. Talk, tell me what those two questions were, and then you'll reflect on the responses that AI had generated for you. And so that'll be the essay, and that's next week. It'll be due on the very last day of class, which is December the 6th, I believe, or 7th, thereabouts. Um, and so that's the last thing that we have to do for this course. So really, you should only have two action items remaining for the course. That is the chapter 26 quiz related to the discussion we're going to have tonight, and the essay. And then really that's it. And then we have the final exam. Now next Thursday on December the 4th, we will talk about the final exam and the essay as well. and so that way you'll be very well prepared to take the final. Tanika, yes, please feel free to unmute your microphone.
Oh, hey,
Hey,
Professor, how are
hey,
you?
how good are you?
Good, thank you.
Right.
For the project that you were just speaking about,
Yes.
so you want a like a short essay and you want the copy and pasted conversation of the AI. Do you want it like a reference at the bottom, or do
Yes.
you want the conversation first and then um the analysis of what the conversation was?
So, great question. So first, I want the summary. Your written summary. Then the conversation, and then lastly the reference. That should definitely cover more than 500 words, I would
Okay,
think.
when you say summary,
Huh?
what does that entail?
Yep. So the summary portion is you're summarizing your findings, right? So you'll write about the topic that you explored. You'll include the two questions that you asked AI, the responses that AI gave you, and then your reflection. That's the summary. Um, so really just the summary. Because that includes basically the two questions, the you're taking the two questions that you asked, you're copying those two questions and the responses out. Um, so so I guess really it's only these four components that you'll have in your report. Number one, which of these topics did you select? Number two, the two questions and responses of the two questions you asked AI related to that topic. Number three, a short paragraph, which is your reflection on the usefulness and limitations of the responses. And then lastly, sentence or two on how the topic connects real world business decision making. That's it. So I figure this will probably be, a page. Does that help to clarify your question?
Yes, thank you.
Well, you're very welcome. Excellent question. And we'll talk more, slightly more about that on Thursday. Brianna, please.
Okay, I just wanted to confirm. So after I know you wanted our summary, then you wanted the conversation with the AI tool. Then under that, we're are we basically like putting it like listing it as a reference, or you want us to like do like a citation or how
Yeah, yeah. Well,
underneath?
yeah. So at the very end of your document, your report, just a real simple citation.
Okay,
Basically what tool you used, when you used it. That's really
okay.
it's easy. It's a really easy report, I promise.
Thank you.
Welcome. Genesis, I see your hand.
I had a question. So, do we have to submit this project, I mean this essay early if we're completers?
Yes, if your intent is to graduate, all of your work, including the final exam, need to be done by that date. Remind me what that date is, Genesis.
The graduation occurs on the 19th, but I think final grades need to be put in December 5th.
Correct. So that yeah, so I mean December 4th, December 5th is when you would need to have that done by.
Okay, thank you.
Thank you. I think I only have a few completers or individuals graduating this term, and I think you're one of them. So great. Thank you. I appreciate that. Okay.
No problem.
So they always make it difficult. I don't know. I just don't get it. Play with my schedule, all kinds of stuff. Anyway, all right. That's enough of the tangent. Let's go ahead and talk about our conversation tonight, which is on capital budgeting. This Some of this will seem familiar to you. If you remember, weeks ago, man, I don't even know how many weeks ago that was now. a while ago. I think it was like week 6, something like that. We talked about the master budgeting process. That was a long time ago. We talked about the master budgeting process, if you recall. And a part of that master budgeting process was this thing called the capital budget. And this is how we figure out the monies we set aside to purchase property, plant, and equipment. And so through that capital budgeting, uh, tonight, from what you remember when we talked about the master budgeting process, we're going to expand on that component, which is capital budgeting. And we're going to look at a couple of ways we go about that. We'll also go through a way that management uses to evaluate potential investment projects. Let's say they're comparing two different pieces of machinery or maybe comparing a couple different project opportunities or whatever. I'm going to show you different ways that management compares those. The payback period, which is how quickly we expect to recover our initial investment cost. The accounting rate of return, which is an internal tool that management sets. The net present value calculation, and the internal rate of return. You probably remember net present value from financial accounting. We talked about that toward the end of financial accounting, or Principles 1. So let's roll on through these things. First, let's talk about capital budgeting. As you recall from our discussion on the master budgeting process, capital budgeting is how management sets aside the cash basically to acquire or sell property, plant, and equipment. Yep, that's what capital budgeting is. Now, there's a process involved with capital budgeting. And so the way that it works is that first the manager submits a proposal to purchase or sell property, plant, or equipment. The second part of the process is the capital budgeting committee, which typically involves all of the managers and sometimes the managers at the higher levels to evaluate the proposal and recommendations, and then they make a decision whether to or vote to approve or reject the proposal. And then those evaluations get sent up to the board of directors for an official approval of the capital investments that the company plans to undertake for that year. And that is really the capital budgeting process. Now, I'll tell you a couple things about capital budgeting with making these decisions as a manager, and I've had to make these decisions myself in business. More specifically, and I think I told you all about a time that I was working in the hotel business. The chiller on our roof had decided to fail, and it was the middle of summer, real hot day, and the building was starting to get real warm. And the chief engineer comes running into my office, says, "Oh, Dr. B, we got a problem. The chiller on the roof is failing. It's reached its life expectancy. We need to repair or replace it." And so I looked at the capital budget to see if we had enough set aside, which we did not at that time. So we had to repair and wait a couple of years to eventually replace it. Uh, it's difficult sometimes in capital budgeting because there's some risk involved with it. There's a lot of risk involved. Number one is the outcome is uncertain. I could have went through and budgeted for that chiller and purchased it, and then what? What happens if it doesn't work out? It's the wrong size. It has issues, whatever. The outcome can be uncertain. And then I just wasted millions of dollars in that process. Which leads me to number two. Capital budget includes lots and lots of money. Purchasing or selling property, plant, equipment, there's a ton of money involved there. So tying up all of that cash, that's a huge risk. Which leads me to the third one is that it takes a lot of time. When you purchase property, plant, or equipment, you expect that you're going to use it for a long period of time, multiple years. It's not just a short-term thing, right? Oh, you purchased the building, you got the equipment, you got the land. Come on now. I mean, that's all long-term stuff. What if it doesn't work out long term? So that's a risk. And then the fourth, which leads us to the fourth risk, which is that what if we made the wrong decision in purchasing that property, plant, equipment? So sorry, but it's really difficult to reverse. It's kind of like the whole chiller thing, right? What if I made the wrong decision and, you know, we purchased the wrong size chiller, or it wasn't suiting our needs or whatever? Are you kidding me? Once that you get the crane, you lift up this several ton machine onto the roof, you get it installed. What do you think? You could just call them up and I'd like to return this chiller I just got installed? Not kidding me? That would be insane and also impossible to do, right? Once it's there, it's there. Okay. So it's almost impossible to reverse that decision, or at any point, extremely difficult. So these are the four risks that are associated with the capital budgeting decisions. So let's talk about, when we make the decision to make a purchase of property, plant, or equipment. Well, it starts out pretty simple. First, there's a cost of acquiring the asset, the property, plant, equipment. So there's an initial cash outlay. I have to shovel out hundreds of thousands, or in some cases millions of dollars up front. Right? It's not like you could just pay for it over time. A lot of times it doesn't work that way. You just upfront cash money, right? Property, plant, equipment, company's got the cash, we shovel out the cash up front. And that cash usually goes for things like materials, labor, overhead, in order to get this piece of equipment built and installed, all that jazz. Okay. So it begins with an initial outflow of cash for the purchase of the property, plant, or equipment. We get it installed, cost of getting it up and operating, all of that is included in that initial investment amount. Then we start using the property, plant, and equipment to help us to generate sales, right? That's why we purchased it in the first place, is helps us to generate sales. That's why assets are there. The assets are there to help the company generate sales. So we start selling, the stuff that we're making using the property, plant, and equipment. Excellent. It costs some money to keep that stuff running, right? So there's some expense related to the property, plant, or equipment to keep it running. And then, some years go by and we use the property, plant, and equipment to our advantage, and then the asset reaches the end of its useful life. Now, at the end of its useful life, it might be worth something, right? It might have some value left over. Call that salvage value. It's basically the scrap value, after all of the depreciation has been taken out. So then we dispose of the asset and we do the whole thing all over again. This is the process of making capital investment. So the capital investment formula, very, very easy. It's the negative cash flow up front, so minus the initial investment, plus sales that we make each year, minus the expenses that we have each year to keep it up and running, plus the salvage value, whatever's left over. That's how we calculate the net cash flow from an investment. Very, very straightforward. So in management, we oftentimes are faced with decisions between one or more projects by purchasing these type of equipment or machinery or whatever. And when we're faced with multiple decisions, we have to select which of these alternatives are best for us, right? And one of the ways that we calculate or evaluate an investment decision is by what we call the payback period. The payback period, in real simple terms, means how long it's going to take in order for me to get paid back that initial investment amount, right? Call it the payback period, how long it's going to take to recover the cost of the initial investment. And to calculate the payback period, it's very simple. We take the amount of the initial investment, so the initial cost of the machinery, divided by the annual net cash flows. That part's a little bit more complicated. It's the sales minus the expenses related to that equipment. Okay, that is how we calculate payback period, which is basically how many years or months it takes me to recover that initial investment. The shortest payback periods are most desirable. Now, I like to recover my initial investment as quickly as possible. Yeah. I'm going to show you an example of this using equal net cash flows and unequal net cash flows. The first, using the equal cash flows. So here at the top, we have an example where our manufacturing company, Fast Track, is looking to purchase a new piece of machinery that has a cost of $16,000. It has a useful life of 8 years and a salvage value of 0, meaning at the end of its 8 years, it's not going to be worth anything. And for each year, we expect that this piece of machinery will help us to create 1,000 units that has a sale price of $30 per unit. Okay, so a great amount of data here. So one of the first things we got to do is figure out, hey, what are the net cash flows going to be? It's sales minus your expenses, right? So we have sales. We're going to we're going to create 1,000 units, sale price of $30 per unit, so that's 30,000. Minus our expenses, we have direct materials, direct labor, factory overhead, variable expenses. Then we have depreciation on the machinery and selling general administrative expenses. So our sales, 30,000, cash coming in, cash going out, expenses, direct materials, direct labor, factory overhead, 16,500. We have depreciation expense, which in this case is $2,000 a year. We calculated that using straight line depreciation, which is cost of the machinery minus salvage value divided by useful life. In this case, $2,000 a year for the 8 years. And we have selling general administrative expenses, which are all of our other expenses. In this case, 9,500. So for the cash flow, we take the 30,000 that came in minus the 16,500 direct materials, direct labor, factory overhead, and minus the 9,500 selling general administrative expenses. Obviously, we do not take depreciation into consideration for cash because depreciation is not cash. It's not the same as cash. So in this case, we have a net cash flow for each year of $4,000. And we expect that same cash flow every year for the period of 8 years. Now we have to figure out what the payback period is. It tells me how long it's going to take me to recover my initial investment. So we take the initial investment amount of 16,000, which is the cost minus salvage value, divided by the net annual cash flow, in this case $4,000. This means that we will be able to recover the cost of our initial investment in 4 years. So 4 years is our payback period. Now that's nice and easy when we have equal cash flows. It's not as easy to calculate when we have unequal cash flows. So let's say we have these unequal cash flows, which is very typical in business. Your cash flows are not always going to be the same every single year. So here we have an example where it was slightly different for the first year, and then it kind of stabilized for the following years. So we had the initial investment, 16,000, and then we started making our sales, our net minus our expenses. First year, 2,000, and then every year thereafter it was 4,000. So it's real simple. I take my minus 16,000 plus 2,000 plus 4,000 plus 4,000 plus 4,000 until I reach my payback period, until I reach zero, right? And in this case, that happens somewhere between years 4 and 5. Now I need to figure out exactly what month that occurred in. So the way I do that is I take a number of years it took for me to break even, which in this case was 4 years, total 4 years, plus the difference, where in between this occurred. So I take the cumulative net cash flow at the end of year 4, divided by the net cash flow from year 4. And that gives me 0.5 of within that 5th year. So this means that 4.5 years is the exact time of my payback period. So that's how we would calculate that using unequal cash flows. Now, obviously, even 4,000 per year is kind of unrealistic. I think that this would be a little bit more varied, but this is the example that we have for today. Now, the payback period, it's really easy. It's so easy to compute, and it only uses cash flows, which is great. So those are the two strengths. But the thing is, like, once you've reached year 4, year 4.5, whatever the payback period ends up being, it doesn't consider any cash flow thereafter. So, I see that as a weakness. And the other thing is a weakness is it ignores time value of money, which means it ignores interest rates and things like that. So it's good. It's easy to use, but it is not the most accurate. The next method that we would use is called the accounting rate of return to evaluate an investment decision in the property, plant, or equipment. And this accounting rate of return is something that management sets internally. And so it's a really simple thing to look at. So for the accounting rate of return, we take the annual income divided by the average investment. Now there's a word again, average. In accounting, we look at this as beginning balance plus ending balance divided by 2. So in the case of the machinery, beginning balance is 16,000. The ending balance is, in this case, is 0 because ending balance, the salvage value is 0. Divided by 2, which gives us 8,000. Average investment. So we take our annual income in year 1, I think it was 2,000, divided by average investment, 8,000, gets us to 25% accounting rate of return. So very, very simple computation. It's great. I like this measurement. But here's the thing. It's great and all, except for the fact that it ignores the time value of money and is not tied directly to cash flow with respect to the timing. So those are the two weaknesses behind accounting rate of return. But it's really easy to calculate, right? Beginning balance plus any balance divided by 2 gets you the average investment. We take the annual income, for each year divided by the average investment gives us the percentage, in this case, 25%. Very, very simple computation, but again, ignores interest, ignores cash flows. So, which leads us to the third method, which is, in my opinion, probably one of the most accurate methods, and that's using the present value in order to evaluate an investment decision. And when we calculate present value, we're applying the concept of what we call the time value of money with respect to future cash flows and outflows. To really understand the viability of a project. And we do this net present value calculation really in 2 steps. The first step is the discounting of the future net cash flows from the investment of the required rate of return, also known as the internal rate of return, also known as the hurdle rate, and by subtracting out the amount of the initial investment. So those are the 2 real simple steps in doing this. Yeah, simple, right? Typically involves some type of financial calculator. When calculating net present value, I always recommend using maybe Excel for this type of thing, or if you have available a internet-based present value calculator, it'll make your life a lot easier. So let's look at this as an example, and this is using equal cash flows just to keep things a little easy for us. Here we have the example of companies considering a $20,000 investment into a new piece of machinery. It will provide $10,000 per year equal cash flows for a period of 3 years, and the company has an internal or required rate of return of 9%. So what we do is we take the cash flow for each year, we'll multiply that by the present value factor amount that we get from a present value annuity table of $1 at the 9% rate. So we take the cash flow times the factor from the table, gives us the present value of the cash flow for each year. We add up the 3 years, we get $25,313. Then we subtract out the initial investment, giving me a net present value, in this example, $5,313. As long as that net present value is positive, we will consider doing the investment. Meaning greater than 0, yeah. So the decision tree looks like this. When we apply net present value, as long as it's positive, we'll probably invest in that project. To find the net present value, we take the present value of each net cash flow, add them all up, subtract out the initial investment to get the net present value of the project. As long as it's greater than 0, we'll invest. If it's less than 0, we will not invest. We do this to really to compare alternative projects side by side. We can also look at that same calculation graphically by looking at the annuity table. So we can subtract out that initial investment, and we can subtract out the net present value based off of the factor of the annuity table. and then it'll get us the same net present value amount. So this just kind of shows us how it's applied using an annuity table. Very, very easy, very simple to do. So it's looking at number of years and the interest rate to find the factor. The amount using an annuity table is 2.5313. Another approach using the net present value of applying an annuity is a way for us to use the present value of annuity factor and multiply that by the net cash flow if the cash flows are consistent year to year. And so in doing that, basically we're taking that 15,000 times 10 to find the 10 years of consistent net cash flows. We can discount it using the annuity table, which would ultimately get us to 92,169 present value for the 10 years, minus the initial investment in this example of 80,000, giving us a net present value of 12,169. So the thing to remember here is that even with this example or any other example for that matter, as long as your net present value is positive, we will consider doing that investment. Now, what happens if we're comparing two alternatives with two different outcomes? So here we have an example where we run through those same exact calculations, cash flow times the present value factor, giving us net present value, add them all up, and subtract out the initial investment, and it gets us a net present value. As long as it's positive, we're going to go with that project. If we're faced with two different projects, we're going to go with whichever yields the highest net present value. So in this case, option B is going to be the best option for us, or project B, best option for us. We can also look at net present value from the perspective of salvage value included in our calculation. So if we were faced with a project that had a salvage value, we would consider that at the end of the project's useful life. So our earlier example, we had a useful life of the project of 10 years. At the end of year 10, we would factor in the salvage value and just add that present value in at year 10. So years 1 to 10, net cash flow 15,000. We had the factor of 6.1446, got us at 92,169. We add in the salvage value factor, year 10, salvage value in this example is $10,000. At year 10, 10% of stated interest gets us 0.3855. Multiply that by the 10,000, so 3,855 present value for the salvage value. Add the two together, we get 96,024 minus the initial investment of 80,000, giving us present value of 16,024. So in this example, all we're doing is simply adding in salvage value based off of the present value factor of an annuity table, which is really the only difference between what I showed you earlier. So when it comes to multiple projects and net present value, it's important to calculate all the net present values for each potential project, minus our initial investment. And in doing so, we can compare multiple projects using what we call a profitability index. The profitability index helps us to apply a weight to each project. And that weight, the higher the weight, implies the higher the profitability. And so if I'm faced with multiple potential investment opportunities or multiple projects, I'm going to go with whichever one has the highest profitability index. So to calculate the profitability index, we take the present value of the net cash flows divided by the investment amount. In this case, investment number 2 yields the highest profitability index, so I'm going to go with that one for sure. And I'm going to completely eliminate investment number 3 because it's below 1. Anything below 1 we don't even consider. So that's profitability index. We can also lastly look at net present value based off of what we call the expected value of the net cash flow by multiplying each individual net cash flow by the probability of that investment occurring. So in this case, 60% being the highest probability, 15,000 times the 60% is 9,000. We multiply each one, we add them up, 14,800. We apply that as our expected net cash flows for each year, times the annuity table factor, giving us present value 90,940 minus the initial investment, giving us present value of 10,940. So overall, those are all the different approaches that we can take with net present value. My recommendation to you is just work through a couple of exercises using net present value, or use a financial calculator or one that you find on the internet, whatever works best for you. But definitely work through a couple of examples. I think you'll find them useful, especially as managers when you're faced with these types of investment decisions. Another approach that management will take when it comes to evaluating a potential project is the internal rate of return, which is very similar to the accounting rate of return. And so internal rate of return is also known as what we call IRR, which is another financial tool that we use to calculate as it relates to potential investments. And we do this really in 2 steps. The first step is we compute the present value of the investment, which is the initial investment divided by the annual net cash flows, which you learned about earlier. And the second step is to identify the discount rate, yielding the present value factor, or the internal rate of return. And the way that we do that is, once we've calculated the present value factor, initial investment divided by annual net cash flows, we find that amount on our table, whichever one is closest to that amount. In this case, it ends up being at year 3 at an interest rate of 12%. So what this implies is that 12% is going to be our internal rate of return. Yeah, it's basically like working backward. Take present value factor, then we take that amount and match that to a factor on our table, and that'll give us the percentage. That's how that works. It's pretty easy, pretty straightforward to use. Again, using a financial calculator will help you here, but this is a really simple approach to internal rate of return. And that's for equal cash flows. Unequal cash flows a little bit more challenging, but nonetheless, it works the same exact way. The decision rule is that if the internal rate of return is greater than the hurdle rate or the accounting rate of return, then we'll accept the project. If the internal rate of return is less than the hurdle rate, then we reject the project. That's really the decision making process there. This next slide, I really like this one. It gives us a nice side-by-side comparison of the different methods that we learned about. The payback period, accounting rate of return, net present value, internal rate of return. Uh, in my expert opinion, I would say the two most accurate ones are the net present value and internal rate of returns. The other ones are really easy to calculate, which is great, but they don't reflect the actualities which involve investing, which involve interest. So that's why net present value and internal rate of return are probably the most accurate ones. And then one of the last things I'd like to talk about tonight is with respect to the break-even time. So how quickly I can recover that initial investment to the point where I reach zero on my break-even. This is very similar to the approach of our payback period. And so all we're doing here is we're taking our net cash flows, multiplying those by the present value factors to get the present value of the cash flows, and we just add them all up. So minus the initial investment plus all the present value of the net cash flows until we've reached zero on our cumulative side. And then once we've reached zero, that is the point of break even. And so we can calculate from there the net present value at the point of break even. So again, a relatively simple approach to understanding how long it takes to recover that initial investment. And then, of course, it wouldn't be a great lecture without at least one computation or one type of ratio or something like that. But I want to just tell you that Excel is amazing when it comes to calculating things like net present value, internal rate of return, anything related finance. And so here we see an example of the internal rate of return being used. And so the way that it works is we put on our initial investment, years, the number of years, the expected net cash flows. We plug those into our array, so we go equals internal rate of return. We capture years one, the initial investment through all of the net cash flows. You hit enter, and it computes the internal rate of return for you. Very, very easy to do in Excel. I always recommend Excel for these types of computations because it's a really powerful tool, and I think it's really valuable. So, believe it or not, that ends our conversation on capital budgeting and investment decisions. Are there any comments, questions, or concerns about the things that we've talked about tonight? Shocking. Too easy, right? Are there any comments, questions, or concerns about what we have to do for the rest of the term? I know that some of you are graduating, which is amazing, but that also means that you have to do things a little bit earlier than everyone else. So, what that means is that for those of you who are graduating, you have two action items to really complete as soon as you can. The first is the quiz related to tonight's discussion on Chapter 26. The second is going to be the short essay on AI and accounting. And then, of course, you'll also need to complete the final exam early as well, since if you're graduating, if you're petitioning to graduate, because I need to submit your final grade. I think it's on the 4th or the 5th, right? So. And then if you're not graduating, you have until December the 6th to complete your essay, and then the final exam, respectively. Comments, questions, or concerns? All of this is open and available, by the way. So if you want to finish these things early, you're more than welcome to. In fact, I encourage you to. if you decide to do that.
Thank you. That's exactly what I was going to ask. Like, can I get the other stuff out the way as
You sure
well?
can, Tanika. You're more than welcome to knock out whatever.
Okay.
I'm not going to stop you for sure. In fact, I would encourage you to.
Okay. Thank you, Professor. Have a happy holiday. I appreciate you.
You're very welcome. It's my pleasure. And enjoy Thanksgiving with your family. So thank you all so very much for your time today. I appreciate all of you, and I wish you all a very happy Thanksgiving with your families. If you need anything in between now and then or whenever, just shoot me a quick email, give me a quick phone call, whatever's. I'll be happy to help you out. But thank you all so very much for your time. Appreciate all of you. Enjoy the rest of your night, and happy Thanksgiving to you all.
Happy
Thank you. Enjoy your
Thanksgiving.
Thanksgiving.
Happy
Thank you so
Thanksgiving.
much. Appreciate you all. Take care. Good night. Ciao, ciao. All right. Good night. Good night.